Welcome back to Strongman Personal Finance, everybody. We got an interesting video here today. We are going to look at some of the amazing options inside of my 401k, and I'm going to show you how I pick my investments. Now, I have a very simple yet effective strategy. I try to match the world stock market as closely as I possibly can because I truly believe that most stocks are fairly valued at all times. Some stocks are undervalued, some stocks are overvalued. But if you're dollar cost averaging into a global index fund over your lifetime, you will roughly pay fair value for the global stock market. You aren't timing the market. You aren't trying to pick winners and losers. You're not buying U.S. stocks, bro, because they went up a lot, or buying international stocks if they go up a lot. You're buying everything at market cap weights. That is my strategy, and if you don't like it, go buy QQQ. Now, in my 401k, which is a tax advantage account, where you can either put money in pre-tax or post-tax, and it either grows tax deferred or tax free for your life, you can pick many options. One of the first mistakes people make is when they put money into their 401k. They don't invest it. Okay, they just put it into a cash account and it sits there and it accrues 1% interest, or well, now it's 5, but that won't be that won't be for long. But they leave the money in there and it just grows very slowly, or basically underperforms inflation in the long run because they don't invest it. You need to pick frickin' investments. Now, what I don't like about most 401k plans is they give you an ungodly amount of options, and they just kind of present it to you. It's like, here you go, what are you going to pick? The second I opened my 401k plan, I knew two things. I was going to buy a U.S. index fund, and I was going to buy an international index fund. And I was going to weight them according to how they are weighted across the globe. Roughly 60% U.S. stocks, 40% international stocks. So I quickly said, okay, what is the most total market approximating U.S. fund? Okay, I'll invest in that. And 60%. And what is the most total market international fund? Most total market index international fund, I will invest 40% of that. And that's it. That's all I do. I'm not thinking about it. I'm not reallocating. I'm not playing freaking games. I'm just investing according to the local market cap weights, global market cap weights. It's as simple as that. But a lot of people, they come on here and they say, which one went up to the most? JP Morgan large cap growth went up 15%. So I'm going to buy that. Well, let me teach you something here, okay? First of all, we're going to compare the Vanguard FTSE Social Index to the Vanguard Institutional Index. Now, the Vanguard Institutional Index is what I'm invested in, and obviously I'm a moron because I picked the one that performed second best out of all of these. Okay, what am I possibly doing? Well, I wanted to approximate the total U.S. market as much as I could, but I didn't want to be too complicated. I didn't want to include 5, 6, 7 mutual funds. So basically, I chose the S&P 500, which is highly correlated to the total market index. So let's compare these two index funds first. So here's the one I'm invested in, the Vanguard Institutional Index Fund, Institutional Shares. Expense ratio, 0.03%. I'm paying absolutely nothing, okay? And if you compare the returns of this index, it's the S&P 500. Okay? It's the S&P 500. It's as simple as that. Now, what people will do is they'll be like, well, I want to be liberal and a good person. I like to socialize. I like the talks. So I'm going to buy the Vanguard FTSE Social Index. Now, apparently this is here to be liberal and amazing, okay? But here's the funny part. Look how closely this thing approximates the S&P 500. It basically tracks the S&P 500. It basically is the S&P 500. And if you look at the holdings, oh my God, I'm so liberal, I'm such a good person, okay? If you look at the holdings, this is the S&P, 7% Microsoft, 7% Apple. 8% Apple, 8% Microsoft. Amazon, Nvidia, Alphabet. It's the same thing, except you're overweighting large cap tech, bro. And you're paying, 3-4 times the expense ratio? Wow, there you go, ladies and gentlemen. Okay, so a common mistake people make is they just, number one, buy stuff that goes up a lot. And number two, they try to be liberal and amazing and pick stuff that fits their beliefs. Okay? which is absolute freaking nonsense. Because if you look at these, the social index versus the S&P 500, it's the same thing. Look at the 10-year returns. I mean, the social has outperformed a little bit. That's only because it's just weighted towards large cap tech, which just happened to outperform. Doesn't mean it's going to happen in the future, okay? And then we have this JP Morgan large cap growth. Now, right off the bat, I already have my suspicions. Yes, net expense ratio. This is 10 times as expensive as the S&P 500. Okay, this looks like an actively managed fund. This investment seeks long-term capital appreciation. 80% of the assets will be invested in equities, blah, 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 blah. Okay. It's got 71 holdings versus the S&P 500's 506 holdings. It's got portfolio turnover of 42%, which means they're trading in and out of stocks a lot compared to 3% for the S&P 500, and you're paying 10 times as much. Now, I wonder what the top... Oh, my God. Wow. What have they done? They've overweighted large cap tech. I keep seeing this trend. I'm crazy. Maybe I'm crazy, okay? But this fund has just invested in the same things the S&P 500 does. They just overweight stuff that went up a lot because that's the genius of active managers in Wall Street. Buy stuff that went up a lot and it goes up more and you are a genius and you get paid for it, okay? This is the type of fund you don't want to buy. 0.44% expense ratio, turnover, okay, trading in and out of stocks, just reshuffling around the largest holdings in the index. Why not just buy the index? This is what the market believes Microsoft should be worth if you're just looking at the total U.S. market. Why are you overweighting and underweighting? Okay, in the long run, the market will beat you. In the long run, it will. Okay, and so we've seen a liberal index that charges 3 times the expense ratio and tracks the S&P 500, and we've seen an actively managed index that just overweights the same freaking holdings that are in the S&P 500. Oh, so you see that? So do you see why I chose the S&P 500? Now this is MFS value. What is this? So the MFS value has trailed the S&P 500 pretty significantly. Doesn't mean it's a bad investment for the future, but what it does mean is that you've basically excluded yourself from investing in a lot of companies. Now, if you look at this index, or this investment, their top holdings, JP Morgan, Cigna, Conoco, Progressive. So basically by buying this, because it says value, you've excluded all of the massively profitable large cap tech companies that probably have a competitive advantage with AI. Like, why would you exclude those? It makes no freaking sense whatsoever. Now, if we look at the cost of this fund, 0.43%. Yeah, that's 10 times as much as the S&P. Much fewer holdings and not crazy portfolio turnover. So out of all these options, I'm going to go with the S&P 500. Lowest expense ratio and tracks the efficient market hypothesis as closely as possible. I don't see what's hard about this, okay? Now we go and we look at, let's say you want to buy small and mid caps, okay? So we have the Vanguard Mid Cap Index. So this one, let me close these other two. This one has a 0.05% expense ratio and it's got a turnover of 12%. So very low turnover, 341 holdings, and it's got a 0.05%. So super low expense ratio. Let's look at the actively managed fund. Now what does the genius do? Oh, well this one went up more. See? Mid-cap growth equity index. So I'm going to buy this one. This one has a 0.71%. So you're paying, what, 15 times more for this because of past performance? And it does well. It did well in the past. That doesn't mean it's going to do well in the future. With a 46% turnover. So I mean, that means basically half the stocks that this fund held last year were swapped out during the year. Okay? Look, the index always wins. Okay? Never look at past performance. If you do, you are a clown. Especially inception, because sometimes funds get incepted at different times. A fund could be incepted at the bottom of a massive bear market and have crazy returns, or a fund could be incepted at the top of a bull market. But that doesn't mean that the fund that has better past returns is the fund that's going to be better going into the future. Does that make sense? Okay? Some of this stuff is just unbelievable. Let's look at this Loomis sale. Oh, this is I can just tell this is going to be nasty. Let's see what this is.
Yeah, I could pay 0.05 or I could pay 82% with a 37% turnover, but basically buy the same stocks that are in the index. What is this? The Victory Sycamore.
Why are these options? Just look. This is why I like the Army Military Thrift Savings Plan. Well, they kind of messed that up too by allowing you to buy other stuff. But the Military Thrift Savings Plan, like if you just stuck to the standard funds, they're all index funds. Like the idea that they have all of this crap in here is very frustrating. Okay, because there's so many options here that you're probably going to choose the thing that went up the most. Like you'd probably choose this one right here. Okay, 10-year return, so it's the best one. And you probably underperform the index in the long run because you're paying such high fees and past performance is not indicative of future performance. I mean, there's just such crap here. Okay, now here's my international. So let me close these real quick. So I had two options here basically for international. So we'll open this one and we'll open this one. I had the Vanguard Total International Stock Index, and I had the American Funds Euro Pacific Growth Index. Growth, bro! So the Total International Stock Index has 0.11 expense ratio, and it has a portfolio turnover of 5%. Let's look at this other one. Oh, 0.47%. Okay, turnover of 34%. Now, I wonder what holdings this has versus the other one. So here's the international index. Okay. Taiwan Semiconductor, Novo Nordisk, and Nestle. Let's see, Novo Nordisk, Taiwan Semiconductor. Is Nestle in here? No. So they flopped around a few of the top holdings. So this is definitely more concentrated in some companies. But at the same time, once again, you're probably excluding a bunch of good companies for some arbitrary reason. And you're paying a much higher expense ratio. Like this is 4 times as much. For what? To like maybe beat the index, but probably not. So, of course, I went with the International Stock Index. Super easy. So, last we have these target retirement funds. Now, I briefly considered these, and there was a reason that I didn't buy these. I like these in some instances, but sometimes they get a little bit weird, okay? Actually, let's see. Do they have... Oh, they have this. Okay. So, when I looked at this, I said, okay, the expense ratio is super low. Pretty good. And basically what this does is this starts automatically allocating you from stocks to bonds, which I think is a good thing overall because a lot of people end up just holding all stocks forever. And you don't want to have that when you're about to retire. You want some liquidity. So here's what I didn't like about this. It's very well allocated according to market cap weights. But the only thing I didn't like was they just had global real estate in here. So I sat there and I said, okay, this is very close to VT. Very close to VT. But they throw in this random real estate thing here. So I was like, well, I would rather just buy the total US or as close as possible and total international and not throw in this random real estate weighting here. But overall, looking at this, it seems a little complicated, and they have so much crap going on here that it's hard to understand. You have to research every one of these. But overall, it's not the worst thing in the world. Okay, if I could not choose anything, I would probably go with this. But I probably have to do more research into what exactly they're investing in. That's the problem. You don't really know. I know exactly what I'm investing in by buying the S&P 500 and by buying the Total International. That's basically it, okay? And then they have some bond funds here. So let's look at these two bond funds. Now, bonds can be tricky. They're not safe. They're not risk-free. And you probably need them at some point, but you got to be careful and not buy highly volatile bond funds with long durations that can massively fluctuate in value due to changes of interest rates right before you retire. So you got to really understand what you're doing. It's not easy. So we have the Vanguard Total Bond Market Index here, which has a 0.03% expense ratio. And then we have this turd, the PGIM Total Return Bond Fund, 0.39. Now, back, not too long ago, interest rates were super low. And funds with this kind of expense ratio were absolutely ridiculous.
bonds have not historically returned as well as stocks. Okay? And if interest rates go down to super low again, you might be paying more in expense ratio than you're getting in interest. So you need to keep that in mind. So especially when it comes to bond funds, I 100% prefer index funds. So right off the bat, I immediately discount this because of the insanely high expense ratio, which is more than 10 times high than the Vanguard Total Bond Market Index. So this is all the options in here. I don't like how everything here, there's so many options. I mean, one option is you do, the total world, or if you just like U.S. stocks, then find something that approximates the total U.S. market, and just that's it. That's all you need. And then, as you get closer to retirement, maybe consider throwing some bonds in there. Or maybe consider a target retirement fund as long as it doesn't have a crazy high expense ratio. It's not actively managed, and it roughly approximates the total world stock and bonds. There's a lot of options out there, but there's also a lot of junk, and you can't be swept in. Focus on expense ratios. Do not focus on past performance, and look at the turnover rate. And when you're looking at these funds, see if they're just rebalancing the top holdings. And it's very apparent up here with some of these investments. The social index is basically this, what I'm invested in. JP Morgan large cap, they just overweighted some stocks that went up a lot. So hopefully you learn my thought process. I keep it super simple, basically VT, or as close as I possibly can, and I just let it ride and I don't change my allocation. Now I will when I get older and I need bonds maybe, but that ain't happening for a long time, okay? At the end of the day, you need to pick your own investments. I like VT. That's what I'm going to keep doing. You do whatever you want. Have a wonderful day. Cheers.